Hi, everybody. This is Steve Elwell, Chief Investment Officer, Partner at Level Financial Advisors, and I'm here with Mike Angelucci, one of our certified financial planners. Today, we're going to discuss all the moving parts and changes of the one big, beautiful bill act, the OBBBA or OBA, or I don't know what we're calling this. I know we called the last one the TJCA, and that's all the acronyms we used. But
Yeah,
nobody's really come up with a fun name for this one yet, and the full name is a bit of a mouthful. So
yeah.
either way, let's call it the new tax bill. How about that?
The new tax. I'm good with that.
Perfect. So the new tax bill was passed and signed into law on July 4th and has a fair amount of changes that can have some pretty serious implications and planning implications for particularly for our clients, but for basically everybody. But very specifically, we're going to cover what we think are the major changes, and also what we think maybe some of the planning implications might be for people who are affected by that. So with the first one, Mike, do you want to take a second just to describe what's happening here with current tax rates, tax brackets, what was going to happen, and what's going to happen now?
Well, what potentially could have happened if there were no changes were the tax jobs, the Tax Cuts and Job Act was going to sunset, which would have reverted the tax brackets to the pre-tax Cut and Jobs Act that was passed in 2016, I believe. So the current uh, tax brackets that we've been living with for 8 years will stay the same, although there's some information in there that's saying the 10, 12, and 22% may get a little bit of a cost of living adjustment to them, but the other brackets look like they're remaining the same. So basically, whatever you've been familiar with is what's staying in place. And there's, I believe, also with those brackets, there's a 1% a year inflation adjustment possibly to those. So we'll have to see.
I saw that as well. Yeah, a little extra inflation adjustment and widening of the 10 and 12% brackets. But essentially, the main takeaway for most people is instead of the rates going back to the old rates like they were going to do starting next year, they're essentially going to stay where they are now with a slight inflation adjustment. For most people, that means that they will continue to pay a similar amount of tax or even a little less, but
Right.
certainly less than what they would have paid had rates jumped up like they would have next year had Congress done nothing. And we've been waiting for years for them to figure out, because everybody knew this sunset was coming at the end of 2025, and we've been waiting and waiting to see what Congress was going to do, whether they're going to make it permanent or let it expire, or some people made permanent and some others expire. So we finally got our answer, which was expected, which
Yeah.
was that Congress would essentially extend everything that is currently in place. So that's relatively simple. I don't know if there's a ton of big change there, Mike.
No, the only one thing is, sometimes you hear these are permanent changes, and really, I think permanent only means that they don't sunset, right? That they're permanent, but a new Congress with a new president in 4 years could change everything around. They're just permanent until Congress acts to change them. There's no sunset,
Exactly. Yeah, there is no such thing as a permanent tax
right?
situation that can always be changed. That's right. One of the most talked about changes, particularly for those in high property tax and income tax states, New York would fall in that category, California, New Jersey, Massachusetts, all sorts of different states, would be the state and local property tax change. So I'll talk very quickly about what the landscape looked like previously before this was passed, and then Mike, I'll kick it over to you. You can tell us about
Okay.
what's changing. So at the current moment, the maximum that you can deduct if you go to itemize your deductions for state and local taxes and property taxes is $10,000. and that amount is the same whether you're a single filer or you're a married filer. So there's actually a marriage penalty there, which has always annoyed me very much, and probably anyone else who is married. But essentially, it was limited at $10,000, and with the standard deduction being so much higher than what it previously was before the TJCA in 2017, ultimately, a lot of people were no longer getting a benefit of avoiding double tax for their property tax and income taxes. So that limit is now being changed. Mike, you want to walk us through how it looks at this point?
The new limit now will be $40,000, and that will start for taxes effective 2025 taxes through 2029. So you will be able to deduct up to $40,000 of your state and local taxes, which will be a big boost for a lot of middle income people that are property owners in New York State for most of our clients. There is some phase outs at income at 500,000 and above. This starts to phase out, so you'll want to be careful that I think it phases out pretty quickly from my reading of it.
Yeah, I think 600 is when it
600.
kicks, and that applies to, again, both single and married,
Yeah, right.
which is, I guess I can't shake my head enough at that. But if you're single, you're making out amazingly with this deal. If you're married, you kind of got to be scratching your head. But I did also read that this would be inflation indexed as well. Is that right, Mike?
Yes. Well, it looks like that they said what I've read is 1% a year
Yeah,
through 2029, and then in 2020 after 2029 it goes back to 10,000.
right, right.
And
I
so
think,
this is a sunset provision on this.
yep, yeah, a temporary change here, potentially, unless Congress takes action in the next 4 years. One other thing I would add, that phase out, if I understand it correctly, and you can tell me if I'm wrong, Mike, if you completely phase out, you don't actually go down to zero. You just go back down to the $10,000 minimum
That's how I understood it.
that you're allowed to deduct. So
Yep,
it's not like your 40,000 turns into zero. Your
right,
40 at worst goes back to 10, which was where it was before all this started.
right.
Yep. Okay. Well, that will be a big one. To your point, I think if you're talking about people who have income below 500,000 are paying a lot of property tax and or income tax, and also if have the ability to deduct like mortgage interest if they still have a mortgage,
Right.
or have a lot of charitable donations that they make. If you were able to itemize before, you're really going to be itemizing now because you're going to
Yeah,
get that extra boost as long as you're not phasing out, and it could be up to another $30,000 on top of what it was before, depending on what you're paying in income and property taxes. So this could be a big one for people that are paying a lot. Yep.
yeah. I mean, for a lot of people, it could be worth $5,000 a year, possibly. So,
Easily, yeah,
tax
easily. Yeah,
savings.
yeah,
Yep.
yep. Now that makes sense. Okay, on to the next item here. The qualified business income, QBI for short, 20% deduction was made permanent. So as a reminder, this is a separate deduction that people get that are self-employed. They're able to essentially exclude about 20% of their income from being taxed. So it's good news for people that are self-employed, but also interestingly enough for investors with non-retirement brokerage accounts who receive dividends from qualified real estate investments, which we use some of, would also participate in that deduction. So that previously was not permanent. Now it is permanent. Mike, your thoughts?
No, I think that's a good thing. One thing the only other thought I had on it was really a commentary. There was hope that professionals like doctors and lawyers and financial advisors and others like that that have individual practices might be able to participate, but apparently that did not pass. So it's just the businesses that
Right.
existed in the previous legislation.
Right. Yep. So not an enormous change. I do think they tweaked some of the phase outs on that or income levels on that, but for the most part, if you were participating in it before, it essentially is not only going to continue but be made permanent at this point. And of course, again, permanent is only until
Right.
somebody else comes along and changes it. One thing we should have mentioned in the beginning that we didn't is a reminder that we're not CPAs. This is not tax advice. We are just speaking generally about all the different tax changes that are coming. And actually, one other thing to point out is not sometimes, all the time when these tax bills are passed, the way they're written leave it up to the IRS and the Treasury Department to interpret those rules and then determine what ultimately qualifies and what doesn't. We're going to touch on that a little bit later with some of the other items. But this is not all fully clarified yet, I guess is the way I would say it.
Correct.
So everybody's doing their best to interpret exactly what the law says.
Yeah.
But ultimately, the IRS and Treasury has to nail down exactly what this really says. So let's all keep that in mind. Next up, note a very proudly and loudly pronounced campaign trail item for the president was no tax on tips. Mike, you want to talk about what ultimately came down the line for that?
So that will be, you will still report all your taxes, and because you're still going to be taxed on your Social Security, Medicare will still be pulled out. And then you will have a separate deduction, whether you itemize or not, where you'll be able to deduct up to $25,000 in tips. And that does phase out. There's phase outs for that. The phase outs are greater than 150,000 for a single taxpayer and greater than 300,000 for married filing jointly. The 150 phases out all the way up to 400,000. The 300,000 phases out up at 550, where then you're not eligible to deduct up to that $25,000. So it is a deduction. You don't have to itemize for that. I think I've seen some things where people are saying, "Oh, you have to itemize." No, you don't have to itemize. There's going to be a separate line on the tax form that will allow you to run that. In fact, some people are even speculating there may even be a separate schedule for for this and some of the other things we'll talk about.
I'm expecting that as well, based on how many separate line deductions are now being created to go along with the QBI. That was really the only thing before this
Right.
that had its own separate line. If you go from one separate line to five or six, then essentially what ends up happening is they usually end up creating a schedule for that. But for
Yeah.
most of us, that will be our accountant or our tax software's problem.
Right.
Nobody's doing these by hand.
Exactly.
So most people won't have to worry too much about that. The other thing is this, our understanding is only from 2025 to 2028. After that, goes away,
Yep.
so not permanent.
Yep.
Does sunset starting in 2029, and the IRS will publish which jobs qualify. So
Great.
one thing that was pretty popular that was going around is, is my doctor going to charge $5 for a visit and then, ask for a huge tip so they can, essentially exempt their income? And that's not going to be able to happen.
No.
It's going to have to happen for occupations that generally rely on tips as a major source of income. So think like waiter, waitress, that type of thing.
Right.
But we'll see. What the details are yet to be totally ironed out from the IRS yet on that one.
Good point. Yep.
The next one, since it's in the same vein, do you want to walk us through the no tax on overtime?
The note in a similar way, this will also be another deduction. So we have the QBI, right? We have tax on tips. Now we're going to have the overtime, and that will be, you will be exempted from overtime tax. You will still report all your taxes, like I mentioned with the tax on tips, so that you're paying your FICA and Medicare taxes or Social Security and Medicare taxes. And that will be, you'll be allowed 12, up to 12,500 if you're single, 25,000 married. And that is on the income that is over and above your base rate. So if you make $10 an hour and now you've gone into overtime, you're making $15 an hour, it's the $5 an hour over which will be exempt up to those limits. How payroll companies are going to track that, again, that's their problem, not ours. But
Yep.
and there's phase outs with that as well. The phase outs are the same as the tax on tips, 150 to 400,000 for single, and then the 300,000 up to 550 for married filing jointly, and that's 2025 through 2028 as well on those taxes.
And I think the one difference I think that I understood between this and the no tax on tips is the no tax on tips is a $25,000 deduction whether you're a single filer or married filing jointly. But the no tax on overtime, interestingly enough, was 25,000 for married filing jointly and only
Right.
12,500 for single.
Right.
Again, I can't help but scratch my head and say, wait a minute.
Mm-mm.
You apply the married doubling for some spots, but you don't apply it to other spots. I don't understand the rationale. But the marriage penalty continues in most spots, but not on overtime.
Right. No, there's no logic to making the sausage. You don't want to know. You're never
Yeah,
going to figure it out. But
right,
yeah, great point there.
right.
Yeah.
All right, next item on the list here was the charitable deduction for non-itemizers. So this is a bit of a throwback. Actually, I was a huge fan of this deduction. So previously, when they changed the TJCA changed to get rid of the lower standard deduction and get rid of the dependents and create this much larger standard deduction. What happened is just about everybody started using the standard deduction. It was like 90% or more of the tax returns started using the standard deduction. But what that also meant was people that give $500, $1,000, $2,000, $5,000 a year to charity, they never
Mhm.
crossed the line to items
Right.
because the standard deduction was so large. And so what that ended up meaning is they didn't really get much tax benefit from continuing to give and support their favorite causes. So what Congress did, and I can't remember the year they did this, but they kicked it forward for a couple of years. They kept it going for a
Mhm.
little while where they would let you deduct, if I remember right, it was like 250 for single and $500 for a married couple. And it was a separate deduction
Yeah.
outside of itemizing. It was just a line item.
Mhm.
And if you gave to charity, you could deduct up to 250 bucks if you were single or 500 if you were married. They're bringing that back, which I love. I think that's a
Mhm. I
great
agree.
idea. And they're bringing that back at $2,000 for married filing jointly and $1,000 for single. So here we are, another spot that there actually is a marriage benefit. But this one doesn't start into 2026. So it doesn't
Correct.
kick in yet this year. But the best part is that this is permanent, or as permanent can be in
Mhm.
terms of taxes. And I love this one, Mike. I'm wondering about your
Yeah.
opinion on this, but I love this one. I think they should keep it forever. I hope
Yeah.
maybe I can't tell, or I didn't see anything as to whether it was going to be indexed for inflation. I guess I probably doubt it.
I
But
did not see index for inflation
yeah, but
at all on
this one
that.
I think is a great idea. I think for most people this is going to be actually very helpful.
I agree 100%. I mean, a lot of people, I think when that legislation came out 8 years ago with the higher standard deductions, and people were saying, I don't have a motivation to give to charity anymore. And I think it hurt charities, and this will only help charities in the long run.
Yeah,
So,
I totally agree. And
yeah.
I didn't see anything on any phase outs for this either. I think this just
Nope,
is.
nope, just
So
is.
yeah, so that's great news for anybody that faces phase outs in any of the other areas of their tax return. So in that same vein, the next point, unfortunately, is the bad news. for those that give to charity and do itemize. So they have now created in this tax law and what's called an AGI floor, an adjusted gross income floor for those who itemize for charitable deductions, similar to what the medical expenses are,
Right.
which essentially says something to the effect of when you go to try and itemize those expenses, the first previously was like 7.5% of your medical expenses don't count, and anything above that is what you actually get to deduct if you're itemizing. And they've now created a floor for that for charitable contributions that is 0.5% of your AGI. So to make the math really simple, if you have $100,000 of adjusted gross income, the first $500 you give to charity, you cannot deduct if you itemize, but anything above that you can. And so that's a little bit of bad news for those that are itemizing. But I suppose if the trade-off is to get the previous point, then most people will probably come out ahead because most people aren't itemizing. What do you think, Mike?
Yeah, I agree. And I think, I mean, with the salt increases for a lot of people, maybe more will be itemizing. They're still going to do their charitable deductions through there because they will itemize. So they'll push them there because I don't think you can choose one or the other. If you itemize, you can't do the 1,000, 2,000 line deduction. So I mean, yeah, it's a little bit of um I guess bad news on this, but it's still people in that income level that are paying that are giving to charity generally give maybe thousands of dollars a year. So um, they're gaining on the salt if you want to try to look at the bright side of that, I guess.
Yeah, I think if you're not phasing out of that salt extra amount that you get to deduct, that would be a good trade-off for you to get the salt but give up some of the charitable.
Yeah.
That's probably still a pretty good trade for somebody. That's a good point though, is I haven't read anything, and I assume the IRS will clarify, but if you are not able to itemize your charitable contributions, but you do itemize in general, can you then take that charitable contribution and apply it to the deduction line that's outside of the itemized deductions, this new line that was created? And my guess was going to be no.
Yeah.
Uh,
That's
but
that's my guess too.
it seems unlikely that they would let you say, oh, if you can't deduct it there, then you can deduct it over
Right.
here. That seems hard to believe. But I'm sure that's one of the things that they're going to clarify for us in the next year here, probably.
As I said with the sausage, my thought on that was there was a compromise there, right? Okay, we're going to give you this 1,000, 2,000, but we're also giving you the increase in salt, so you got to give us something back to
Yep.
help pay for this other. So, it's all that back and forth is my guess.
Yep. Yep. That makes total sense. Yep. All right, another one that's been very popular in the news to talk about is the $10,000, up to $10,000 car loan interest deduction,
Mhm.
which kicks in immediately for this year and lasts through 2028. So again, another piece here that sunsets after 2028. But this one comes with some hoops to jump through. Mike, you have any detail on any of those hoops or phase outs?
If it's got to be purchased after December 31st, 2024. It's got to be on a loan. Leases don't count. It's up to $10,000 in interest that you can uh, deduct. And again, it's not itemized. So again, another one of those separate deductions. Um, and it's got to be for a regular vehicle. It's not an RV or anything like that. And final assembly in the United States on the vehicle. So uh, I'm sure the people that have those vehicles will be marketing that aggressively in the months to come. And although
Mike, does it also does it also have to be a new car?
new car, yes,
Yeah,
correct.
can't
New
be can't
car,
be a used car that fits
no,
all the other boxes. Has to be a new car.
yep. And this, as the others phase out single, the phase out starts at 100,000 and totally phased out at 150, and married, filing jointly, phase out, or starts at, the phase out starts at 200,000 and, it ends at 250,000. So over 250,000 of AGI, adjusted gross income, you're not going to be able to take that deduction.
So it'll be nice for anybody that qualifies. Some hoops clearly that you have to jump through. Unfortunately, if you already have a loan that was prior to January 1st, then not gonna help you.
Nope.
But yeah, probably a little help there for the auto industry for those that are being final manufacturing here. Next item is actually very simple, but will help everybody, or at least everybody that uses the standard deduction, is across the board standard deduction additional inflation adjustment on top of what was already done for 2025. So for a married filing jointly, an additional $1,500 of standard deduction. And again, at this point, I know the SALT stuff is going to change some of this, but last year, for instance, 90+% of tax returns would have been using the standard deduction. So this is going to apply to a lot of people. An extra $1,500 for married, an extra $750 for single. No phase outs or anything to have to deal with any of that. No sunset or anything on that one either, I think, Mike. We're permanent on that one.
It's permanent.
Just kind of a boost at this point.
Right. And the over 65 extra is still in there at 1,600 per person if you're married. So that could be $3,200 for a married couple and 2,000 for a single. So
right. And in that same vein is probably the second, well, at least my opinion of what the second largest impact of all of this is, at least for our clients for sure, is so you already mentioned, we just covered the standard deduction boost, and then you had always received a boost for being over 65.
correct.
Now that boost gets a second boost, which is a $6,000 boost per person that's over 65. But this one comes with some phase outs, whereas the other boost did not have phase outs.
Right.
And of course, the standard deduction didn't have phase outs. So this one is a big one. Now, the phase outs start a little earlier than some of the other phase outs. So if you're a high income person over 65, you have sort of a different set of rules that you're really playing by. But this one at 6,000 per person is a pretty big number. The phase out start at 150 for married filing jointly and 75,000 for single. But that's a pretty big number. And this was it's not exactly as advertised, but this was the piece that was trying to mostly eliminate taxes on Social Security.
Right.
But interestingly enough, you don't have to be claiming Social Security to get it.
Correct.
It applies to any of your income. So,
Right.
For instance, if you're 67, still working, let's say you're married, you're earning $80,000 a year, you don't have any other sources of income, you haven't started your Social Security yet, you both would still get your 6,000, even though you're not actually claiming any Social Security yet. So in terms of planning opportunities, what comes to mind when you think about people that might qualify for those extra large deductions, or anyone who is close to the phase out?
One of the first things that came to my mind was potentially larger Roth conversions for some people, if they're doing that, if they're not working, or if they're within a certain tax bracket that makes it sensible. It's going to give them more room to work within those tax brackets to make Roth conversions. That was the first thing that came to mind. And there's even the potential that you could, when you're talking about this, it came to my mind. If people have brokerage accounts, you may want to limit what you're taking out of qualified or IRAs so that you stay under certain, these phase outs so that you get these deductions. So there's going to be some interesting tax planning at the end of the year for us in the next few years to try to work around or work this to our advantage.
I totally agree. The tax planning in all the items that we've covered so far, but when you look at the SALT stuff, the senior deduction stuff, the extra standard deduction stuff, the outside charitable deduction stuff, even if you don't itemize, I mean, there are a lot of opportunities to sort of strategically plan around each of those to ensure that you maximize the value of all of them and minimize the amount of tax legally that you're required to pay. So it's not as if tax planning wasn't important before, but it's even more important now because there are just so many different things that you kind of need to pay attention to as you work your way through it. I don't have the note here, but I think I know the answer. Maybe you can confirm for me, Mike. I think this phases out as well after 20, is it 2028 or 2029? This goes
I have
away
2028 in my
after
notes.
2028. Yeah. So here's another one where often what we see with something that might be as valuable as this is when it gets right up to the deadline of being about to sunset, just like this year happened. Congress says, we don't want to let that one go. And, they
Right.
pass, like right in December of that year, usually they pass something. So maybe that one will stick around. We'll find out, 3-4 years from now. But that's going to be a big one. I do think that's going to save a lot of people a lot of money. And I had read some statistics that prior to this bill being passed, that something like 60 to 65% of people collecting Social Security were not paying tax on their
Correct.
Social Security. And now that number is expected to be somewhere around 90%.
Right. I've read 88% to be precise.
So,
It's,
well,
it's
you're on the ball like
what's been
usual, Mike.
published, but yeah, it is, but it's not a change to Social Security tax itself, like you
Right,
said. It is just a deduction that will effectively eliminate the cost of the tax that you're uh, getting through because of Social Security,
right,
I guess.
right. Yeah.
I
So Social
guess.
Security's own tax formula as to how much of it counts as taxable and how much is not is so complex that we don't even want to try and explain it. You can't do it on the back of a napkin.
Nope.
And it is a strange set of rules and calculations. But ultimately, I think what I had understood is if they tried to fully just say none of Social Security is taxable for anybody, that would have tripped some of the rules for the reconciliation process that they were using to pass this, which
Yes.
would have meant they needed more votes to get it done, which they probably wouldn't have been able to get because they would have needed some people on the other side of the aisle to chip in. And so ultimately, I think this was for trying to reduce taxes on Social Security, probably the only route they really could have went. But having said that, your point's not wrong, is that
Yeah.
this does not eliminate tax on Social Security. It just dramatically reduces the amount of people that will pay tax on Social Security.
And we know, I mean, just a commentary, we know really the limits on what people pay on Social Security, what those limits are for what's taxable. And to hear the number was 60 to 65% that aren't paying, there's a lot of low income seniors out there based on the provisional income calculation of what's taxable for Social Security. So
Right,
I was surprised by that number
right,
when I read it like you.
right, right. Well, in effort to not go too long here, we've only got a couple more items to touch on. Most of them are pretty small here. So the next item is the child tax credit, which has been made permanent now, which was $2,000 per qualifying child, is now $2,200 per qualifying child. Also will be inflation adjusted going forward, has been
Mhm.
made permanent and kicks in right in 2025. So if you have a qualifying child, which I think has to be under 17, if I remember, Mike, 17 or
Yep,
under,
yep.
good news for parents, going to save a little bit more money there on taxes. Mike, you want to tell us about the estate tax exemption, how that changed?
The estate tax exemption has bumped up to $15 million per person. There's portability, what's called portability. So a married couple can effectively have $30 million in exemptions before their estate has to pay taxes. So if you basically have an estate upon the death of the second um, couple person in the couple, then essentially there will be no estate tax
Yep.
to your beneficiaries.
Yep. So some clarity on the estate tax planning. There was a big question and a rush for planning for anybody who this applied to is, if they let this go, essentially would have been cut in half. And
Right.
that would have been a dramatic change for anybody who was in between those numbers. So some clarity there. Next item is an expansion of eligible expenses for HSAs and for 529 plans. Now that's going to take the IRS some time to clarify exactly what this expansion means. So we're not going to go deep into detail on this one, but they're talking about the ability for some primary care arrangements for HSAs, some telehealth stuff, for 529s, including things like testing fees or tutoring, but we still need a lot of clarification on
Yeah.
exactly what is going to qualify for those two things. But to be honest, anybody using 529s or HSAs will welcome any expansion, even if ultimately they don't use it. The wider amount of things you can use it on is generally a good thing. And then the last item here, which caught a little bit of press as well, is the creation of what are being actually called Trump accounts. That's the formal name, Trump accounts, which is this kind of new creation of an account for newborns and children below age 18. There's still
Yes.
some lack of clarity on exactly what is going to apply here. Mike, what detail do you have on that?
Oof. Well, there's a lot. One, it doesn't really go into effect for a year. I don't think you can make a deposit. There's got to be a lot of clarification to different custodians and so forth. The government's going to potentially give $1,000 to each child born between January 1st of this year and the end of 2028. So it's like this open window, which I think will lead itself to when it sunsets to like keep these things going. But you don't have to have earned income, or the child doesn't have to have earned income. Apparently, there's a provision to allow employers at some point to add $2,500 a year to these accounts. They're going to look a lot like an IRA. There's not going to be a tax deduction when you put this as after tax money going in.
Right.
And then it looks like there's some provisions when the child, let me get this right. Um, when the child gets to age 18, there's no withdrawals up to 18. At
Right.
18, 50% can be used for higher education. I think small business startup or first time home purchases.
Yep.
I've read, but then I've seen a contradiction to this, that the money out of there will be, any gains will be taxed at capital gains rates versus when you take it out later in life, the growth will be at your marginal tax rate.
Right.
Uh,
We're
and
gonna, yeah, I think we're gonna get a lot of clarification on exactly how these works because it seems very ambiguous as to what all the rules are.
a
But in
couple,
essence, the general idea, though, if I understand it right, is let's set aside some money for newborns and young children and let it grow for 15, 18 years and then give them a head start on life. I mean,
yep,
that's kind of the gist, and the government will kick in a little money to incentivize you to start them. And other places have done this. So we'll see ultimately how that ends up kicking out. In fact, I think the state to look at was Connecticut, which had like baby bonds was the
the
story
baby bonds,
there. It's kind of
yes,
like
yep,
modeled after that. But listen, anything that can give a head start for children, because as we all know, compound interest is the real magic of
yep,
saving and investing and creating wealth. So if you got $1,000 in an account for a baby that doesn't get touched for 18 years, that's going to turn into a lot more money than somebody thinks it probably will. I also
yep,
heard there were some restrictions on type of investments that the money could be put into, which
Yes,
essentially is like index fund, mutual funds, or ETFs. But I have to say that's probably better than U.S. Treasuries that they might have, required
right.
based on how they do other things like Social Security. So again, more detail will be coming on that, but kind of an interesting concept. Not going to start until next year, I believe. So
And I think
we'll
too,
see.
Steve, that it'll probably you'll have to go direct to some custodian because I think the other issue too, not an issue, but one of the, I think a good thing is that there's the fee ratio on the index funds that can be used has to be 0.1% or
Yep.
lower.
Yep.
So that's probably you're going to go direct to BlackRock or Vanguard or Fidelity that may offer these.
Yep. Yep. Yeah, I'm sure they'll probably restrict. Well, they have to restrict what's going to be allowed to be purchased inside of those accounts. Yep.
Yep.
Well,
I think it's just
we will see.
US funds. I don't think there will be international
Oh,
right now.
right,
Yeah.
right. Yep, yep. So lots of things going on, lots of little tweaks around the edges, but the big picture is tax-wise, bracket-wise, most of us will be staying where we are as opposed to getting higher. And
Mhm.
all these different deductions and credits and ability to take different tax savings maneuvers will be very important to pay attention to. So at this point, we've covered everything that we think is the major points of this. Mike, any final thoughts?
Nope, I'm looking at my notes and I think we've pretty much covered them. I mean, there's some other issues around things being eliminated, like the EV tax credit and some of the residential energy things that will be, uh, eliminated next year. The EV tax credit on cars ends after September 30th. So that's the only other thing I had on my notes that we didn't touch on. And, a lot of the things we talked about are especially kind of these tax on tips and overtime and the 6,000 or 12,000 deduction that people can take. These are all, you don't have to itemize for these. I think that's an important point. Because,
Right.
I'm seeing things where people are, online, people saying, oh, you have to itemize, you're not gonna be able to take this. That's not gonna be the case.
Yep. Yep. So as we said before, again, none of this is tax advice, but we do strongly suggest that people take tax planning very seriously because it just became that much more complicated with all these moving parts. And so if you have any specific questions, please reach out to us or your specific advisor. We're always happy to help answer questions. And with that, we're going to conclude our update on the new tax bill that's been passed, and we will talk to everybody soon.
Right. Thank
Thank
Talk to you
you.
soon.
Take care.